Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market video for January 2023. Now, last time we did a video at the start of December, tanker spot rates were at exceptional levels, particularly in the Aframax sector, where rates hit record highs during November and December. Since then, we have seen a softening in rates led by the large crude carriers, especially the VLCCs. I think that's reflective of reduced OPEC output, primarily from the Middle East, as well as reduced Chinese oil demand due to a recent spike in COVID cases there. However, rates do remain strong on a relative to historic averages, with Aframax rates still exceeding $60,000 per day. And just in the last couple of days, we've seen rates strengthen again in the Atlantic, and Suezmax rates have started to come up again as well, which is very encouraging. Looking ahead to the rest of the year, there's two key themes I want to touch on with regards to the outlook for tankers. The first is the outlook for Russian oil exports, and the second is Chinese oil and tanker demand. So starting with what's happening with Russia, the EU ban on Russian crude oil imports and the G7 price cap both came into effect on December 5th last year. Now, in the first couple of weeks after December 5th, we did see that Russian crude oil exports fell quite substantially by as much as 1 million barrels per day. But after that, in the last 2-3 weeks, we've actually seen that they've come back quite a bit. And the 4-week moving average is now almost back to where it was pre-December 5th. So that shows that at the moment, there doesn't appear to be too much disruption to Russian crude oil exports, despite the EU ban and the price cap, especially due to the fact that at the moment, Russian Urals crude is trading well below the price cap of $60 per barrel. However, I think it is probably still a little bit too early to tell what the longer-term trend will be, and we expect there will be some volatility in Russian exports in the coming weeks and months as oil prices fluctuate, particularly if the price of Russian crude does move above the cap, with Russia saying that they will not sell oil to any countries which implement the oil price cap from February 1st onwards. For now, though, the change in trade patterns that we've seen continue to be very positive for mid-sized tanker ton miles, as Russian crude is forced to go longer haul to China and India, while Europe has to source replacement barrels from further afield. And this should ensure that the mid-sized tanker fleet remains stretched in the near term, which will support spot tanker rates. Turning to China, the government recently announced a reversal of its zero COVID policy, which had been in place since the start of the pandemic in early 2020. It's been quite a dramatic U-turn from the Chinese government. They've now lifted lockdowns, ended mandatory testing, and eliminated cross-border travel restrictions. Now, in the near term, this has led to a massive spike in COVID cases, which could worsen in the next 2 to 3 weeks ahead of the Lunar New Year, which is the first major holiday since the pandemic began, in which domestic travel will be possible with minimal restrictions. So this could dampen Chinese oil demand in the near term and lead to reduced imports, which may be negative for VLCC demand in particular. However, as we progress through the year, we do expect that the reopening of China's borders could lead to a significant increase in oil demand due to a rapid recovery in both domestic and international travel. Airlines are currently only operating at about 10% of pre-pandemic capacity for international routes in and out of China, but this could recover through the course of the year to around 80% or more by the end of 2023, which will create significant oil demand. And this is very important for oil and tanker demand in 2023, as China is expected to be one of the main contributors to growth, given the potential impact of recession in Europe and North America. And looking at projections from the IEA, global oil demand is expected to increase by 1.7 million barrels per day this year to 101.6 million barrels a day, which would take oil demand back above pre-pandemic levels for the first time. Now, of this, China is expected to account for about 50% of global oil demand growth, with an acceleration from Q2 onwards as the country starts to open up. And this should be very positive for tanker demand as we move into the second half of the year, particularly if China sources a large proportion of those additional barrels from Russia, which again would help the mid-sized tankers. So what does this mean for tanker markets in the year ahead? In short, we expect that the continued redrawing of trade patterns for mid-sized tankers and a sharp recovery of Chinese oil demand will support the tanker market in 2023, supported by low fleet growth due to a shrinking order book. However, we can't ignore the fact that there are some headwinds in the near term, such as the threat of recession in certain parts of the world, restrained OPEC supply policy, and some ongoing uncertainty over the trajectory of Russian crude oil exports in the coming weeks and months. And as such, we do expect the rates could be a bit up and down through the first half of this year. We could see some volatility. But as we move into the second half of the year, an acceleration of Chinese oil demand should prove to be very supportive. And this should push up rates as we go into the latter part of 2023. And that strength should hold over again into 2024, a year in which we expect zero fleet growth. So overall, I think we're still quite bullish on the outlook for the tanker market. There's bound to be some ups and downs, and rates are going to show some volatility. But on the whole, we think that this year will be another good year, and we remain very positive on the next couple of years as well, due to very low fleet growth. So that's our outlook on the conventional tanker market, and we'll speak to you again next month.